From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the last day of May 2024. Checking the calendar, well, it's festival season, and starting us off this weekend is Festa Italiana. Then Sunday is Sheboygan Harbor Fest, or how about the Wisconsin Beer Lovers Festival at Bayshore Mall? And at the Riverside is the classic rock band Chicago. And if that's still not enough, your Milwaukee Brewers are home with the Chicago White Sox. It's summer in Milwaukee. A South Korean student removed a piece of art from an art museum and ate it. It was valued at $120,000. So what was this valuable piece of art? It was a banana taped to a sheet of cardboard. When asked why he did it, the student said, "He skipped breakfast." How about this? A turf war broke out in Mexico between a fire eater and a mariachi band. They both claimed the same street corner where they performed for tips. The band ganged up on the fire eater, and his best defensive move was to breathe on the mariachi band and start them on fire. Everyone was arrested. Well, this is getting out of control. A Russian cargo plane had a door blow off on takeoff, scattering 3 tons of gold onto the runways. If you were real communists, they would applaud the redistribution of wealth. And finally, AI is everywhere, and it's a little scary. It's even scarier is a computer that thinks it's funny. A group of UC Berkeley smart aleck and geologists for fun asked their AI, how many rocks should a person eat in one day? AI's answer, you should eat at least 1 small rock a day. More than that, you'll get gallstones. You'll be at the Chucklehead all week. All right, on the podcast today, we have Joel Driesing, John Sandstrom, Kendall Bauer, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A strong Friday for the Dow and the S&P, not enough to turn the indexes positive for the week. The NASDAQ down 1.1%, closing at 16,735. The S&P 500 down 0.5% rather, closing at 5278. That's down 27 points. And the Dow Jones Industrial Average, despite adding 575 points on Friday, still down 383 for the week. That's down 1% to close at the bell at 38,686 for the year. NASDAQ now up 11.8, the S&P up 11.3, and the Dow trailing, but still up 3.5%. A quick look at the week so far. Kendall, a pretty strong May overall. Difficult for clients, I think, as they look at statements that'll start getting delivered to those that are getting e-delivery into their email inboxes here probably on Saturday, Sunday, going into next week. I think not a lot to be too upset about. You got returns virtually across the board that seem pretty positive.
Yeah, I think anytime we're up, or the S&P's up over 11% midway through the year, I think it's something to be positive about. In my experience, I think we all suffer in some way or another with recency bias in our lives. And it's something that comes up in conversations with clients from time to time is, hey, the markets were down yesterday or this week. And it's like, sure, yeah, they were, but hey, year to date, you're up 10, 11%. I think, sometimes it's nice to pause and, back up a little bit and just take that bird's eye view. But also good to see, I think, a broader market rally, and of course the Magnificent Seven still doing well, but nice to see other parts of the market kick in.
I think plenty of opportunity out there. A reminder that in any given day, in any given week, to your point, anything can happen. And if you base your kind of decisions on how's my portfolio doing based on what yesterday's returns were when you come in today, well, you might have a very different view of what's going on. And I think, John, some of the economic news paints a similar picture. We had 2 different members of the Federal Reserve speak this week. Slightly different stories, and yet maybe they're speaking the same underlying data. You had Neil Kashkari, one of the more prominent members of the Minneapolis Fed, speaking. His thoughts differed maybe slightly from Jerome Williams in the New York Fed, but I think what they had to say was pretty important. And I think what we've learned is when the Fed speaks, we're going to pay attention to what they have to say.
Yeah, and this is actually something that Art and I have talked about recently, is how the markets react to what the Fed says. And it almost seems like they're begging for them to talk about lowering interest rates sooner rather than later. And they really, really swing on what they are saying, especially if it's something that leans towards the possibility of a rate cut. But going back to actually listening to what they're saying, if you actually listen to what those guys said this week, is they're going to be patient. They're going to remain data dependent. That's what they've said all along. And right now the data is starting to point in the direction where a rate cut could be possible, but it's slowly getting there. It's not something that they're going to rush into, and they've kind of been on the same page from that regard. But the data is still mixed, and they're just going to be patient with it.
I think data dependence is the key, right? And that's what the Fed has said all along, even back to their incorrect assumptions that inflation was going to be transient. Yeah, inflation is going to be transient, but also we're going to remain dependent on the data with respect to what we do with rates. And so I would hope that's the answer. I know there's a pretty good history of the Fed not wanting to seem political, not stepping into the political landscape and cutting rates or raising rates around election time. I don't know that that's necessarily the biggest motivating factor. I think the bigger motivating factor right now is that inflation still runs a little hotter than we hope, and the economy overall is fairly strong. And so I don't think you point to the election as the reason why they do or don't, and maybe they do later in the year or post-election, but it'll be more to do with what's going on with the economy than it will, well, we're in the middle of an election season. And Joel, I think on the economic front, plenty of updates this week. You know, the one that I think captures a lot of headlines because it's somewhat easier to understand is gross domestic product. We got an update on first quarter. Maybe not as good as we hoped, but still signs of growth.
Yeah, it's the gross domestic product, the GDP, is our chief measure of how the economy is doing. And as John said, you know, we're slowly getting there. It's, you know, we talk about soft landings. The soft is the economy getting softer, and the landing is actually getting the inflation rate down to where the Fed wants it long term, and that's 2%. And so the word we got this week on the GDP is that on an annual basis in the first quarter, the economy grew at a 1.3% rate, which was slower than its first estimate. They have three different estimates on each quarter on how the economy is doing, and the first estimate actually said it was 1.6% growth. So it was not doing as well as they thought, but it's still growing, which is, you know, the point. And the inflation rate stayed about the same as it was in the prior estimate. And then we got news today looking at more monthly data, and that showed that in April the inflation rate, I mean, was, and this is the number that the Fed likes to look at the most. It's called the Personal Consumption Expenditure Index. And that's at 2.7%. Again, the Fed wants it to be at 2%. 2.7 is, you know, bigger than 2, but it's getting down there because it was 7.1% back in June of 2022. And I actually looked this up. So just before COVID, the rate was 1.6%. Remember, that's a reminder that for a long time, we couldn't get it up to 2%. We couldn't get the economy growing fast enough that that inflation rate was at where the point where the Fed wants it.
Well, and I still remember sitting in at Marquette University at a luncheon with the Chicago Fed president at the time, and him explaining to the audience the nature of the kind of how the mandate works. It isn't we need it to get to 2%. It's that over periods of time it needs to average 2%. This idea that you have symmetry in inflation, and with rates in inflation running as low as it ran for so long, a little hotter than normal inflation wouldn't have been a bad thing. Certainly we got too far. But if you start to then think, well, we ran it well below 2 for years, it isn't the end of the world to run a little bit above. I'd still like to see it get back towards 2 here in the near term and maybe stay there. But again, I do think it speaks to how the Fed views the world more broadly, which is none of this stuff is what's happening in a single month, what's happening in a single quarter. It all speaks to what's the broader trend for the economy, what's the broader trend for the data.
And also, just for perspective, since 1961, the average inflation rate was 3.4%, which makes 2.7 look pretty good.
Well, we're in a great place then. I think consumers potentially may be seeing that as well and starting to feel a little more confident.
Yeah, mixed signals on consumers this week. Consumer confidence from the Conference Board was up for the first time in 4 months. There's an underlying number in there that says that some consumers are still worried about recession in the next 12 months or so, although with that soft landing thing, we're not seeing that as much as we thought we would even a year ago. But so consumers are a little more confident, but we're also seeing more reluctance from consumers. The spending numbers from consumers in today's report from the Bureau of Economic Analysis and yesterday's report on the GDP both showed that consumers are holding back a little more. On Wednesday, we had the Beige Book come out, which is a report on anecdotal evidence that economists are seeing at the Federal Reserve branches around the country. And what they were seeing there is exactly what we're talking about. Businesses are actually a little more downbeat. They're seeing the growth in the economy being very slight. And economists are seeing that consumers are maybe holding back, that there's more of a fear of rising prices. And so consumers are trying to resist that more. And, we've talked about anecdotal evidence around here about people not buying the name brands and trying to find cheaper ones because the prices are up.
And we've seen that quite a bit in grocery stores as well, with a lot of folks transitioning to store brand, a lot of folks transitioning to, maybe the Walmart brand instead of the national label brand. And I think, you see it then in the profitability of some of those companies that supply those. And so it's interesting, even in those kinds of conversations, there's opportunity. Even in those kinds of conversations for investors, there are ways to benefit. And so, I think as we look at some of that economic data, encouraging to see that it's still mostly strong, encouraging to see that we're still seeing some growth. I think the one area that continues to raise some concerns is on the housing side. And data this week on both prices and kind of outstanding sales, right? What's in the pipes or what's in the works right now, and some signs there that there's still some weakness in the housing market.
Yeah, the S&P CoreLogic Case-Shiller Home Price Index, which is a mouthful, found that the adjusted for inflation, that home prices hit a record for the 9th time in 12 months. So the prices are still up there. The National Association of Realtors reported that pending home sales was down almost 8% April from March. And the thing that was a little hopeful about that is that the realtors are seeing more inventory coming onto the market. So theoretically, that should decelerate some of these price increases. And if mortgage rates keep staying around the same, or maybe even go down if the Fed cuts rates later in the year, that could, increase demand for housing, and the market could benefit from that.
We've got a newsletter set to come out this afternoon. One of the kind of leading, I think, pieces in the newsletter is just a reminder of what's going to be going on here in Milwaukee in mid-July. I think starting the 15th of July with the Republican National Convention. And Joel, some reminders to our clients, to our readers, that maybe not the best time to want to come downtown.
Right. Yeah, we're offices, and we started this with a staff meeting a couple of weeks ago, just to sort of give everybody heads up and make sure that everybody's getting in touch with clients to say you probably don't want to try to navigate the changes in traffic patterns and so on downtown that week in July. And so, as we did during the shutdown during COVID, I mean, we've pretty much perfected how to deal with clients and handle their needs seamlessly without being in person, so we can do that for that week.
And we'll still have the skeleton crew in the office to be able to handle those one-off needs. But, none of this is a political statement, certainly. It's a reflection of the fact that, when you have that kind of traffic congestion, that kind of potential disruption to our area, the last thing we want to do is bring more people into that madness. And so I think it's a good opportunity for us to kind of make sure that all of our workers are avoiding that, but also that all of you, our clients, can avoid it. And of course, it leads to a broader conversation, Kendall, about just the nature of politics in general and how that relates to our investments. I know we get those questions quite a bit. I know you get those questions quite a bit. But I think a good reminder that the markets aren't maybe as politically driven as we might otherwise think.
Yeah, I think contrary to popular belief, and as Bob has pointed out many, many times over the years and decades, it's all about earnings and interest rates. And I love that. Can we see volatility in election years in the short term? Certainly. But over time, markets are going to revert back to fundamentals. And if you think about it and you go through the thought process, and the example that Bob used, in some of our meetings, is, when it's time to buy a new washer or dryer or put a new roof on your house, right? All these things that we spend money on as a country, consumer spending makes up the vast majority of GDP. People typically don't dictate those spending decisions based on who's in the White House. So the fact that people will continue to spend money will drive earnings, which will drive markets. So just a good reminder, sometimes as we get closer to the end of the year and to the general election, everyone's going to be hearing more and more noise. And, we're always here to have those conversations if, clients are feeling a little nervous or seeing a little more volatility. Give us a call. We're always happy to take time and talk with you about it. But again, we've talked about this numerous times. I won't, open it all back up again, but, doing your preparation and portfolio, kind of risk management ahead of time is what's going to allow you to not try to be reactionary if markets go through a correction or we see more and more volatility.
Yeah, and I think that's key. It's planning ahead for things you might be concerned about short term, because longer term, there's immense opportunity out there. And how do we get to that opportunity? Well, we have a plan for how to deal with the short-term uncertainty. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.